Hello, my name is Jenni Mulligan. I'm from Trust Property. I'm here with Jose Delgado, the founder of Iprotect. So today we're going to cover asset protection.
That's right.
Thank you,
to become
Jose.
financially bulletproof.
Yes, and to be able to operate in the world out there without having the fear that someone could ever target you and your personal assets, your house, your private.
Yeah, so Jenny, a lot of people see it from that optic. I look at it as basically peace of mind.
Okay.
All right. So people are conditioned from the time they can think to own everything. Right. Now, if you have any ambitions of being a successful business person, investor, entrepreneur, whatever the case is, you've got to be quite crazy or seriously passionate about what you're doing.
Yes.
And people don't stop for a minute to think about what happens if I lose everything. We're too busy building and growing and investing and all these good things without thinking about, hey, could something go wrong? Because we all believe that we're infallible. We don't make mistakes. We don't get divorced. The law could change. Hell, did anybody see COVID coming? All right.
Yes.
So whilst I wouldn't say or position it from a fear perspective, certainly that's what people should be thinking. They should be scared that they could lose everything, but rather come from a position where if I own nothing, I have the comfort that if anything ever goes wrong, I own nothing. And I'll circle back to my little thing I said earlier where I'm going to make our objective at Iprotect, which is actually the title of our business name. I protect my assets. Okay,
Yes.
That's the genesis of the name. So we protect everything you have in structures outside of your personal individual capacity. So if anything ever goes wrong, you own nothing. What have you got to lose? Much easier.
Well, my gynae stopped operating and delivering babies, but when he did stop, he shared with me that he spends R1 million a year on insurance. Now, he has delivered thousands of babies. He delivered my own 3 babies, right? I've trusted my life and my children's life with him. And he's got to have R1 million insurance every year in case something goes wrong. That's quite crazy. That stops people from being able to operate. So I think we operate in a world where we should be our full self-expression, give everything, whatever you've got to give it, and not be scared that they're going to come for your private home or your private assets.
Yes, so unfortunately, people don't know what they don't know. Okay, so people charge off and they're busy building their empires and their businesses and all these good things without thinking about the ramifications. So your doctor, your gynae example, very apt. We're not promoting that people become reckless now, or they set up structures to screw people over, or sort of do something in that sort of vein. So there's a lot of laws that can also rein in people that are cavalier and sort of are operating strangely. So we're not going to go down that line.
No.
But structures actually that are available to protect an individual are like trusts almost 1,000 years old. Okay, so they've been around forever. Where have we been?
Trusts are 1,000.
Almost 1,000 years old.
Wow.
So it developed during the Crusades, the whole Christian-Muslim boxing match. Yeah. So then landowners would take over land from one of the knights or crusaders who didn't come back. So imagine the family is now left destitute. So that's the concept. They would leave land in trust with the local abbot or the clergy or the church. Okay, so that's a concept of how it actually evolved all those years ago. Right, so that's trust, and people are familiar with the concept, and it's actually an Anglo sort of file thing where a lot of Germanic and European countries don't have trust. It's an English concept.
Okay.
That is now evolved and morphed to the US and Australia, and so wherever England colonized anybody, you'll find trust. Right, so that's the one entity you have available.
Yeah.
The other limited liability structure that you have is a company. So a lot of people are familiar with a company. Now that goes back about 500 odd years. Okay. So stuff is like,
this
been
is
around
ancient.
for like trust 1,000 companies 500 years. When they would go and send the sailors out on expeditions and voyages, what would happen is if the sailors didn't come back, the person who sponsored the expedition, normally it was like the monarchs of the time, but there was wealthy merchants, they would have to pony up and pay the family of the deceased. So they said, this is not such a cool idea. What we're going to do is we're going to create this fictitious thing called a company.
Yeah.
You contribute capital towards this box.
Okay.
Creditors of this entity are only allowed to claim up to what's the capital in the company. So see, that is the genesis of limited liability.
Okay.
Right? So moving forward, people now decide or get to understand, hang on, I burnt my fingers last time because I've done business with Exco. So how do I now extract or create a position where if that entity doesn't have sufficient capital, then I can pursue people. This is where sureties and collateral and guarantees and warranties outside of the entity come into play.
Yes.
So there's a myriad ways that one can set yourself up to protect yourself. However, as I mentioned earlier, it's not now a license to run amok and sort of not pay people and not honour your obligations. Even your gynae,
Yes.
I presume he would want to honour if there was some claim against him.
Absolutely.
But you know how much cover is enough? That
Absolutely.
million PR, how much does it cover? The claim could be massive.
Yeah.
So he's intending to do the right thing. There's a claim,
Yeah.
and now it's not enough.
Yeah.
Now he loses his home that
Yes.
he's worked so hard for over all these years, and his
Yes.
investments and so on and so forth. So asset protection is key.
And ring fencing things so that they are in their own category.
Totally. So in our world, your point of departure is always to ensure you get the right structures in place. Otherwise, you're building your empire on wobbly ground. Okay? And it's crazy. 20 years later, everything you built, gone. We've seen clients, like a very sad case, I remember to this day, he was about 82, he signed surety for his grandson's construction company. Belly up, liquidation, 82-year-old loses everything.
Oh, wow.
Now is dependent on his kids, and he was a successful, wealthy gentleman in his own right.
Oh,
Isn't that something like
wow.
so left field that could
Yeah.
become a wipe out?
Yeah.
Doing the right thing, and then, like I said, no good deed goes unpunished.
And you know what's so funny is you're talking about this 500 years ago and 1,000 years ago, and I'm thinking that nobody teaches us about money. Financial intelligence is not taught. They teach us how to count money in accounting or maths, but they don't actually teach us how to make money, how to protect it, how to turn it into extra money using gearing and, you know, using the bank's money to make more money. Nobody teaches this stuff out there. So I love the idea that we're going to consider protecting whatever you're going to make, and then consider looking at how do we pay the least amount of tax humanly possible without doing anything wrong. And
Within the ambit of the law.
Within the ambit
I'm
of the
an
law.
attorney.
Thank you, that's the words I was looking for, yeah. So do you want to talk a little bit about the tax as well, just as a general?
We can talk about it generally. I think what we should is maybe have a session completely on tax, but
Yes.
But you're absolutely right. Going back to what you said, we are financially illiterate. So if you look at our logo, Iprotect, it is financial freedom
Yes.
and financial security through financial literacy.
Yes.
So it's crazy that it's not taught thoroughly when you're growing up.
Yes.
Fortunately, I'm a good Portuguese boy. We lived in, in like businesses and that type of thing. So I learned about money and people and trading and profits and taxes in the belly of the beast. Most people don't have that benefit, unfortunately.
But even that 82-year-old who's been through business for 80 years or 60 years, whatever, never knew you don't sign surety if all your assets are sitting in your personal name.
Correct. You're sitting there, lined up. Yeah, so if you don't understand finances or you're not financially literate, you're just going to be the sucker who gets taken out.
Yeah.
Or alternatively, if you're very successful, you voluntarily pay too much tax.
Yes.
So we see PhD, cum laude professors and doctors and surgeons, and the minute you say debit, credit, they get brain freeze.
Yes.
They have no idea about numbers. They go, look, I want to go to this conference, I want to deal with my profession, and I don't want to deal with HR or numbers or invoicing or taxation. Very sad.
It is.
Until we demystify the concept, and it's not that complicated. If people in the know want to educate you, because here's my amateur conspiracy theory: is that people don't want you to understand what's really going on.
Yes.
Like our profession,
I
the
agree.
attorneys, I'll sit behind my mahogany desk. I've got to keep you in the dark so that you've got to keep coming back. So I'll keep invoicing you. And I am generalizing, and I'm not casting aspersions on any particular profession. But if, like the finance world, investments, they make it so arcane and complicated that the average person just goes, I'll make the money you invested.
Yes.
These people are making huge commissions,
Yes.
banks, the documentation and the legalese and the complexity around getting a facility It's crazy. So they're not really your friend. They're fair weather friends. When the rain comes out, the umbrellas are gone.
Yes,
and you've seen it a million times.
And I've actually always been interested in finance, right? So I went and did a accounting and finance diploma kind of thing, because I thought I'm going to make money somewhere along the line, and when I do, I want to be able to understand it and count it myself. Because I'd heard of all these people that take your money and steal, from accountants to bookkeepers that disappear with your money, and lawyers. And it's renowned that these things happen out there. So I didn't want that to ever happen to me. So I've always had this fascination for it. But I think the biggest training or lessons that I've got from you was when I realized that if I ring fence all of my assets into the right separate entities, then if I go and make a mistake in business, an honest mistake that might not necessarily have been done intentionally, they can't take my family home. They can't take my family furniture. So I did, after meeting you, and we did put my property that I owned into the right entity. I did make a mistake one day, and I did end up having creditors looking at my house, and they were not interested in it because it was in a separate entity. On top of it, was bonded anyway. It's not like they would have had any profit from it, but
you've got a roof over your head. As long as you pay the mortgage,
and it gave me time. It gave me time. I didn't have to get thrown out of a house and home with my 2 babies. I had like a 2-year-old and a 5-year-old at the time. And later, one of the creditors that were involved in this mistake I made wanted to come and fetch all my furniture. They sent the sheriff of the court to fetch all my furniture. And because of what you taught me, I could pull out my asset register, which in those days was an old Croxley book, and say, this is the trust's asset register, which had legally been transferred into the trust. Yeah. And the sheriff patted me on the back and he said, clever girl. And I'll never forget that, and I'll never be more grateful than forever and a day that I never had to have my children's cots removed while I'm busy suffering from a mistake that I made. So I think it's such a valuable thing to be able to give people, to say, like, there are ways that you can protect your furniture and your personal house from creditors, from mistakes, from the tax man having their bit.
Exactly. So we'll also speak later on about the succession planning benefits and focus really on the taxation. But in having done this for 25 years, obviously we come across a lot of people who've done like 35,000 structures.
Wow.
But a lot of people have some ethical, moral dilemma. Can you believe that? So it's very easy to get them to understand why you should do this. Because Jose, I'm an upstanding, honourable person, I pay my debts, and I go, oh really? When the bank is wiping you out and taking your 10 million rand home and selling on auction for $1 million, and then suing you for the balance.
And I've watched that.
Ethicals, morals all fly out the window. So why don't we view it this way? Let's use an analogy. Everybody understands car insurance. Pretty simple. Do you take car insurance because you want to drive into a lamp pole or have it stolen, or you want to bash into another car? Hell no. You've got it because you know it's a prudent thing to do. It's a high value item, and I've got insurance. So I want people to rather think about securing their assets in various structures as like insurance against what may befall you. Could be anything. Okay, we don't have to have this crystal ball and try to fathom each and every single eventuality, because you'd never fathom each and every single thing, because life happens.
Absolutely.
Okay? So take the contrarian view or the reverse view. So I don't know what may happen. So let me get myself to own nothing. So if anything ever does happen, I'm sorted. So hopefully we've dealt with the moral, ethical dilemma and said, look, it's not like that. But if you are really feeling all philanthropic and want to pay your creditors, at least it's on your terms.
Absolutely.
So you've got all your assets in your structure, you go, hey, it was actually my boo-boo, and you know what, I'm going to give you 10 cents in a rand.
Which is exactly
Which
is exactly what I did back then with your advice. And it was fantastic.
You
to
can
be
have
able
settlements.
I could negotiate, I had the power.
Exactly, because the shoe's on the other foot. Most people, the rope's around their neck, they're painted into a corner, they have no choices, they don't know their rights, they're threatened. My experience again, people who are in financial distress do not have the luxury of running around to top lawyers to get advice to help them out of the corner.
At that
so
time.
It's a double whammy. You had the assets, now you don't, and now you don't have the money to defend yourself, and you're getting railroaded. You see
all the time.
Liquidations and sequestrations, it's like a hectic industry. People are like really browbeaten, and if they had money, the outcome, the result could be very different, but they don't. So why wait to get to that point? It's like insurance, peace of mind. You take all your stuff, you stick it away. Okay. Then the next step is, if you've seen the light and you understand that you can move all of your structures, the next step that we see is people take all their eggs and they put it into one basket. Okay, so now, as you know, we are proponents of multiple structures, which often is seen to be, it's like overkill, until again something goes wrong. So would you want your house in one structure, together with your commercial building, together with your business, and the debt and the loans? Okay, it's just crazy.
And I've stopped people from doing that before and sent them, and they're so grateful again forever. So I really love making a difference for people and saying, like, you know what, I sell houses, yes, but what happens if in 20 years' time something does happen? At least you know you bought it in the right structure.
So from a property perspective, let's say I call it Fort Knox. This is my little safety deposit box, and I put everything into that structure that's personal. My home, my holiday home, my vehicles, my investments, all that stuff. Then if I'm going to go out and create a property portfolio, I could even have multiple silos. Now, I'm not going to oversell it, but let's just say you've got a structure for your investment property. If something goes wrong there, it doesn't affect my personal stuff. Or if I'm getting into the commercial space, I could have a commercial structure. Or I have a ball bearing manufacturing company. It's about what is your appetite for risk. Again, I don't believe anybody would want to lose everything. So
yes, and ring fencing those. So from your teachings, I've taken my personal home in one structure, my investment properties are in a different one.
Absolutely.
And now I don't feel that either of them can touch each other.
Well, this is it. I mean, just to try and create a thought experiment to get people to visualize this. The old domino effect. Okay, one thing goes and everything goes. But if you have like these massive silos between these different assets, you can't get there. Okay, so instead of an explosion, you have an implosion, and you quarantine the risk relative to that asset or that opportunity or that business only. Okay, so that makes sense. You personally own nothing. Then you take it a step further, and then you take specific assets and you put them in specific structures. Right. So hopefully this is all making sense to whoever's watching. The next step though is, okay, Jose, that sounds fantastic. I want to be financially bulletproof. I want to take all my stuff and move it around. But I went and spoke with my advisor, whoever it is, accountant, attorney, tax advisor, and they go, but Mr. X, do you know what the transfer duty is to move your mansion?
Correct.
Or do you know what the capital gains tax are going to be? Okay, and that just puts a whole wet blanket on the ambitions to do this. So
they've got limited information, and it's not necessarily accurate.
So again, this is horses for courses. So many years ago, like we said earlier, I'm an attorney, but one of the nice ones. Okay, so we don't sue people, we don't do divorce, labour, criminal, all that nasty stuff. So we've focused on being an inch wide and a mile deep on only what we do. So we're at the forefront, and we've innovated and that type of thing relative to what we do, only structures. So we can help anybody move any asset from their own name, okay, or if it's in a wrong structure, because sometimes it is the wrong structure, no CGT, no transfer duty, no VAT, no securities transfer taxes, no creation of loan accounts. Okay, but that's because we focus very narrowly in a very specific area of the law, which is corporate commercial tax. And unfortunately, generalists will have to know a little bit about everything, but they don't know a lot about one specific thing. So we've honed our efforts and our focus at Iprotect to do three things principally. Make people financially bulletproof, which is what we're talking about here. On the event of our death, we're all going to die.
Absolutely.
Surprise. And then on your death, it's very costly, and then there's massive capital gains taxes, executive fees, estate duties. So if you own nothing, that's zero. You've just taken that whole problem, made it go away. If you're going to get sued, you've got no worries. You'll be stressed, but you won't worry. And then when the rubber really hits the road, because hopefully you don't get sued.
Exactly.
And when you're dead, you won't know what you're doing this for, but it will be for the family. But where you get the massive benefit is the taxation. So we find whether you're a business owner, a self-employed professional like a doctor, your guy, or whatever, or a property investor, people are voluntarily paying too much tax. Can you believe it? So if you want to do that, rather set up a foundation, and we can help you be philanthropic with your own money instead of giving it to the government to be philanthropic for you. So, exactly. A quick example. Here's let's say your Ghani. He's not structured. He's successful. He's paying 45% tax, and I'm avoiding all the little deductions and that stuff. Let's just go highest tax rate RSA 45%. we can structure the gynecologist to get him to pay maximum 27% tax. That's 18% per annum. Right? You've got 1% compounding per annum over 20 years, it doubles your capital. Imagine what 18%.
Just say that again, you said you can get him down to 27%, and then you said that's 18%. What do you mean?
So I'm bringing the rate down from 45 to 27, so I'm saving 18%.
Saving 18%.
So if you made $1 million that year, it's 180K in your pocket.
That's 180,000.
You're making 5 million, suddenly it's 900 grand.
Yes.
And life's not a competition, but imagine your gynae and gynae X, okay? And after 5 years, the picture looks very different for one versus the other. 45, 27. Okay, if we work on real numbers, let's just say there's $1 million, okay, your gynae takes home 550, the other guy's taking 730. Okay, and in year 2, another 550, 730. Doctor 2 sitting at 1.460, and the other guy's on 1.1. Yes. I mean, it's the divergence is just going to get massive. That's only after 2 years.
Yes, after 10 years.
And then you're not going to sit on your hands, you're going to take that cash and you're going to invest it. And if you're in the wrong structure, you're getting the wrong type of returns. There are ways to achieve like investments and or in your own business where you can extract tax-free dividends. Biggest open secret in the world. Or in South Africa. Where is it? So there's the section. Even a lay person can understand. It's only 2 lines that shows you how to get exempt tax.
Yes.
Dividends tax.
And let's go back to death quickly, the thing nobody likes to talk about, right? But now, when either of these people die, there's 20% death tax over the first 3.5 million, I think it is.
3.5 to 30. Then it's now 25% over 30 million.
Then it goes to 25%. But there's death tax, right? So even after we die, we're paying death tax.
Keep taking a chunk out of here. No response.
Now add the executive fees, etc. Someone is getting a third sometimes of your money. So if you've got 3 children, that's the taxman is one of the children, and your
biggest one.
Together with the executor maybe, but definitely you've got a 4th child that you weren't expecting, and they are getting a quarter of your money. I never wanted that, and that was one of the reasons why I came to see you and why I wanted to have all my structures right. I even wanted my insurance policies to go to a trust, so that is also not going to be taxable, donations tax and inheritance tax and all those taxes go away if it goes into the right structure.
So again, if we just think about what we proposed earlier, the solution's multifaceted. So it would be pointless. Let's say you're 95 and you go, I've got all these structures for asset protection. I never got sued. Life was great. It was a waste of time. Okay, so asset protection is our point of departure, but then it's multifaceted. Like I said, it's about tax savings, it's about succession planning, because it's not just about the taxation. Intergenerational wealth, as much as we like to think our kids are the brilliant and the best and the most awesome, they may need protection from themselves. Okay? Their relationships, their bad business dealings. And if you look at why the wealthy get wealthier, it's through this intergenerational sort of setup of these structures. So family A worth 100 million, or let's just use 10 million. Family B, 10 million. Structured, 10 million actually succeeds to generation 2. Whereas if you're not structured, between 20 to 40% even can go. So family A now, instead of getting 10, they're getting 6. Comparison, family B's got 10. They're already on the front foot. Family B takes 10 and they double it, let's say. Again, the 20 goes to generation 3. This lot took their 6 and let's say they doubled, they've gone to 12, they've come back to 8. So look at this 8 million versus 20, and the disparity just becomes raging.
And it's because the entity doesn't die.
They continue in perpetuity, absolutely.
So nothing happens when you die, whereas normally it is so traumatic. I watch this all the time because I sell property for these people. And normally you've died and now they freeze your bank accounts, you've got to get out of the house because they can't afford to pay the mortgages, etc., etc. Here, nothing happens, nothing gets frozen, life continues, and you can deal with what you're meant to deal with, which is your grief.
Sure.
And your,
just the
your
emotional
money
side
doesn't have to be taken.
Jenny, this loops back into financial literacy. Okay. Now, the industry that seeks to make funds out of your death, they're not out there screaming and raging. In fact, one of my pet peeves is like, we'll do a free will for you.
I know.
Okay? It's not free.
It's at
maybe
4%.
the drafting is free, but a lot of people are blissfully or oblivious to the fact that thank goodness that executives' fees are capped legislation-wise at 3.5% plus VAT if they're a vendor. So no VAT, 3.5%. If the executive is a VAT vendor, it's 4.025%, but it's of the gross amount. Okay, so a lot of people do have debt. So quick example, you're worth 11 million, you've got 10 million rands worth of liabilities. Your net is 1 million.
Yes.
The executive takes 3.5 of the 11.
Yeah.
So suddenly it's not 3.5. If you look at the net, that's almost 35%.
Correct. So if you had one child, you now have two.
Well, you just create this wood to beat yourself. It's compounding.
Yeah.
And then, unbeknownst to many people, the executor gets 6% of the revenue that flows into the deceased estate.
Oh.
Didn't you know that?
I didn't.
Okay, so there's the deceased estate. Okay, it gets frozen.
Yeah.
Now a separate sort of estate is set up. That's the deceased estate. It's got like its own tax liabilities. It's earning money. So let's say there was a property generating rental, and or there's investments that are returning dividends, or there's money earning interest. Okay?
Yes.
The executive takes 6% of that. So not only do they take a big bite at the cherry at 3.5%, they also are paid annually 6% of whatever flows into the deceased estate.
And how long does it take to wind up an estate?
Okay, so let's not get me started here. But in the normal world, where our barrister, our justice department would work functionally, it should be 8 months, 10 months. It does depend on the complexity and our beneficiaries. Where are they? The size of the estate? Are there businesses? Are there properties? Are there other partners? So it's record turnaround about 8 months. Okay, because you also got to do advertisements and you're going to get through the master and all these things. But let's say a year.
Yeah.
Okay, and in this day and age of the master, 2 years.
Yeah.
So imagine sitting there and there's all this lolly on the other side and you can't get to it. It's like shopping through bulletproof glass. You can see what's yours, but you can't get your hands on it because the estate's not wound up.
Yep.
Again, then when it comes to, let's just digress quickly, the costs that are due to SARS, the CGT, they start hucking you for around about a year. They want that.
And
got to be paid cash.
Death triggers CGT.
That is a disposal event. Can you believe it? So you get taxed to death, and then on your death, they take another few bites at you. Yeah.
So in this country, you pay CGT as well as
death tax.
So we
State
pay
duty, twice
tax after we die.
Most countries, it's one or the other.
Yeah.
We seem to be blessed by both.
Sorry for laughing. It's just
no, it's crazy. But here's the solution. So if you just sit down and think for a minute, you go, I own nothing. So when I die, no CGT versus 18. My executor, in fact, we have a program, and I'll have a little quick plug here. If you join our program, we actually wind up your estate for zero executive fees. But anyway, no state duty, sorry, no capital gains tax, no executive fees, no state duty, because I own nothing. I've taken the time to educate myself, understand how these things work, and it's not overly complicated if you have the right persons holding your hand. So it depends who you want to assist you in your journey. Okay, but there are solutions, fixed fees. We pioneered that in the late 90s, so people know exactly what they're in for. So it's not how long is a piece of string, or this is going to be very costly. So it is relatively inexpensive, but it does take the will for people to get out of the inertia path and say, I'm going to change and I'm going to set up these structures, and I know there's going to be a little bit of work because people unfortunately spend more time planning their holidays than they do planning their estates.
Absolutely, and people are embarrassed to talk about death and what's going to happen after I die. Can I tell you, when I sell the houses for clients and I watch people fight over what's left, you wish you had discussed before the time exactly who gets what. Because it's destroyed the family.
Totally.
It is emotionally traumatic to watch all of that, even for me, from over here. Rather talk about it and say, this is what you're getting, this is what you're getting. Be clear.
So it's interesting, in our sort of experiences, we get to see all sorts, and I promise you, fact is much stranger than fiction. So we always say, where there's a will, there's a relative. I promise you they will pop out of it anywhere. And the other thing we do see is, shame, the body's not even cold, and the fighting is on it.
It's on.
You know our partner Chanel here, she heads up our estates division. Twice we've had to actually get an interdict served by the sheriff on the family to stop plundering the estate. Because they were coming in, they're taking artwork and pieces. It's like, listen, man is not even cold yet. So yeah,
it's
that's
terrible.
crazy. Yeah. So why not be in charge of that
Absolutely.
situation?
Yeah.
Yeah.